It promised guaranteed daily crypto returns. Thousands of people believed their money was safe. But behind the scenes, there was no real investment at all. Just new victims paying off earlier ones. When it collapsed, over $40 million vanished almost overnight. This is the story of Hyperfund/Hyperverse, the crypto Ponzi that paid old investors with new victims' money. What was Hyperfund/Hyperverse? To understand this scheme, we need to take a step back and look at how it was presented. Hyperfund began in mid-2020 as part of a group of investment brands connected to the company Hypertech. It went through several names, starting as Hypercapital, then becoming Hyperfund, and eventually rebranding itself as Hyperverse in late 2021. And the platform was marketed as a cutting-edge crypto investment and passive income solution, claiming to generate profits through crypto mining, decentralized finance projects, and even metaverse gaming platforms. Investors were told that by simply depositing funds and holding membership packages, they could earn daily returns of up to 0.5 to 1% per day, amounts that would deliver hundreds of percent gains over time. Early promotions showed polished marketing videos, flashy websites, and professional social media content using buzzwords like blockchain innovation, next-gen investments, and passive income for life. But underneath all that polish was a simple truth. There was no real business activity generating those returns. Nothing sustainable, nothing transparent, nothing independently verifiable. And no legitimate mining rigs powering all this, a fact that would later become central to fraud allegations against the company's founders. The appearance of legitimacy. From the outside, Hyperfund looked credible, even exciting. It claimed to have millions of members worldwide and operated groups on multiple social platforms where affiliates celebrated earnings, shared referral links, and encouraged others to join. Founders appeared at online events and Zoom meetings, touting global growth plans, partnerships, and supposedly sophisticated blockchain technology. But here's the thing. It wasn't generating money from mining, trading, or any real business operations. Instead, it sold membership packages to investors who paid with Bitcoin, Ethereum, or stablecoins. These packages promised fixed daily rewards that seemed too good to be true, and in hindsight, they were. To add to the illusion, Hyperverse even hired an actor to pose as a CEO at its launch, a person with no verifiable record in the tech or blockchain world. Some promotions even used fake celebrity endorsements, photos or videos suggesting support from well-known figures. None of these endorsements were genuine. All of this created a false narrative of legitimacy until it began to unravel. How the scam worked: daily payouts and incentives. In the early days, Hyperfund/Hyperverse did pay returns, or at least numbers appeared in member accounts. These daily rewards created a sense of trust and confidence. Members saw value grow day by day, and in many cases, some early investors were able to withdraw their initial capital and even some profit. But that wasn't because of real earnings. Instead, here's what was happening behind the scenes. The platform took in cash from new investors. A portion of that money was used to pay returns to earlier investors. This cycle creates the illusion of profitability, so long as more money keeps flowing in than out. This structure is classic Ponzi logic, named after Charles Ponzi, who ran a similar fraudulent scheme in the early 20th century. Even more troubling, Hyperverse was not just a Ponzi scheme. It operated as a multi-level marketing MLM structure. Members earned referral commissions for bringing in others. Deeper levels of recruitment earned extra bonuses. The incentive to recruit was strong, with leaders encouraging people to bring friends, family, co-workers, and strangers into the project. This turned the whole thing into a pyramid-style dynamic, where the only real income was from recruiting more victims. Tokens, memberships, and mystery. Investors bought tokens or hyper units, which were linked to the system's internal rewards. They were told that once these matured, they could be converted or withdrawn. But this was always dependent on the platform's goodwill, not on real liquidity or market value. In reality, these tokens had no legitimate external market, and many investors later found they couldn't convert or withdraw them at all. Red flags everywhere. Looking back, There were multiple warning signs that should have made investors think twice. Number 1. Guaranteed high returns. No legitimate investment can guarantee consistent high daily returns, especially in crypto markets that are famously volatile. Number 2. No independent audits. There were no third-party financial audits, no published revenue statements, and no transparent proof of mining operations or real assets behind the claims. Number 3. Heavy emphasis on recruiting. When a business's income relies more on referrals than actual product or service value, that's a classic pyramid dynamic. Number 4. Fake leadership. Hiring an actor as CEO and promoting him as a legitimate tech founder should have raised immediate suspicion. Number 5. Regulatory warnings. Several financial regulators around the world, including the UK's FCA, New Zealand's FMA, and Canadian authorities, issued public warnings about hyperfund/hyperverse, labeling it a suspected scam or pyramid-like structure. Still, hundreds of thousands of investors ignored these warnings, convinced the platform would continue delivering returns. Collapse. As with every Ponzi scheme, Hyperverse's collapse was inevitable. By late 2022, the flow of new investments could no longer keep up with the demands for withdrawal. Members started reporting delays, and then outright blocks on withdrawals. Accounts that once showed growth now became frozen. Customer support went silent. Websites disappeared. Social media channels went quiet. Suddenly, the platform that once touted guaranteed income was nowhere to be found. Some of the worst-hit investors reported tragic consequences. People who had taken out bank loans to invest said they felt hopeless when they could not access their funds. In some communities, individuals reported severe emotional distress and even suicidal thoughts tied to the losses. Regulatory agencies estimate that consumer losses from the Hyperverse/Hyperfund collapse totaled over $1.3 billion to $1.9 billion globally, a staggering impact for what was essentially a fraudulent investment pyramid. Legal action and aftermath. After the collapse, authorities began to take action. In the United States, the Securities and Exchange Commission, SEC, filed civil charges against Hyperverse promoters, alleging wire fraud, securities fraud, and the unregistered sale of securities. Australian blockchain entrepreneur Sam Lee, one of the founders, has been charged with conspiracy to commit fraud and faces possible jail time if convicted. The SEC also alleged that promoters used false pretenses, misleading statements, and fabricated credibility to draw in investors. One senior promoter, Brenda Bitcoin Butte Chunga, agreed to settle charges, and the SEC alleged she made millions personally, spending on luxury items like cars and real estate. Meanwhile, the legal ripple effects continue, with ongoing court cases and civil actions aimed at trying to recover funds for victims, holding promoters accountable, and deterring future frauds. Lessons learned. Crypto scams may look modern, but the formula never changes. Guaranteed profits don't exist. Referral-based income is dangerous, and if you can't clearly verify where returns come from, you may be funding someone else's payout. The collapse of Hyperfund and Hyperverse isn't just another crypto fraud story. It's a warning for every investor. If something sounds too good to be true, it usually is. Always understand how a platform really makes money, check for regulation and independent audits, and be cautious of recruitment-heavy incentives. Most importantly, protect your financial and emotional well-being, and never invest money you can't afford to lose. The story of Hyperfund/Hyperverse is a stark reminder. In the world of money, trust is a valuable currency. Whether it's crypto, stocks, or any new financial innovation, never let flashy promises blind you to the fundamentals. Subscribe to the Scam Report for more real breakdowns of financial frauds, so you can protect your money before it's too late.